Two guys, same age, same city, same starting salary. They graduate college together, move into apartments 3 miles apart, and both decide, at the exact same moment in their late 20s, that it's finally time to start investing. One commits to $200 a month, the other commits to $500. Now here's where most people would just do the math, subtract the difference, and move on. But that's not the story. The math isn't even close to what you think, and by the time this video is over, you are going to look at that $300 gap in a completely different way than you do right now. Let's call them Marcus and Daniel. Marcus is the $200 guy. He's responsible, thoughtful, but cautious with money. He reads the headlines, he knows the market can crash, and he's decided that $200 a month is realistic for him. He doesn't want to feel stretched. Daniel is the $500 guy. He's not richer than Marcus. He actually makes slightly less. But Daniel made a decision, quietly and without fanfare, that changed the entire trajectory of his financial life. And most people never figure out what that decision actually was. Here's what almost nobody talks about when they compare these two numbers. It's not really about the $300 difference. It's about what that $300 represents inside a compounding system over time. Because compounding doesn't add, it multiplies. And when you multiply something larger, the gap between outcomes doesn't grow linearly. It explodes. Let me show you exactly what I mean, and I promise this is where the video gets genuinely unsettling. If Marcus invests $200 a month starting at age 28, putting it into a broad market index fund earning a historical average return of around 10% annually, by the time he's 65, he has approximately $1.06 million. That's real. That's significant. Marcus is a millionaire. He did the right thing. He should feel proud. Now let's look at Daniel. Same age, same index fund, same market. He puts in $500 a month. By 65, Daniel has approximately $2.65 million. That's a $1.59 million difference from a $300 monthly gap. Think about that for a second. Over those 37 years, the actual cash difference between Marcus and Daniel, the real money that left their bank accounts, was about $133,200. But the outcome difference? $1.59 million. The market didn't just reward Daniel for saving more. It rewarded him at a ratio that defies common sense. For every extra dollar Daniel put in compared to Marcus, he ended up with roughly $12 more at retirement. That's not saving, that's leveraging time. And here's where human psychology does something fascinating and deeply damaging. When most people look at $200 versus $500 a month, their brain frames it as a sacrifice question. It asks, can I afford to give up $500 a month? And for most people in their late 20s, the honest answer feels like no. There's rent, there's a car payment, maybe student loans, definitely a social life. So they choose the number that feels safe. They choose $200, and they tell themselves they'll increase it later, when things are more stable, when they get the next raise, when life settles down. But life never settles down. That's the trap. And the data backs this up. A 2022 study from Vanguard found that fewer than 30% of investors who started at lower contribution rates ever meaningfully increased them. Not because they couldn't, but because the initial number became their psychological anchor. The brain treats the first number you choose as the correct amount. Everything else feels like extra. This is why the starting number matters more than almost any other financial decision you will make in your 30s. Not because the math is different, but because your identity as an investor gets locked in around whatever you commit to first. Here's something that surprises almost everyone when they first hear it. The wealthy don't think about investing in terms of what they can afford. They think about it in terms of what they want to arrive at, and then they reverse engineer the monthly number from the outcome. That's the inversion. Average investors ask, how much can I set aside? Wealthy investors ask, how much do I need at retirement? And what does that require from me today? It sounds like a small shift in framing. It isn't. It fundamentally changes the number you pick, and it fundamentally changes your relationship with money between now and then. So what does it actually take to go from $200 thinking to $500 thinking? Because this is the part most finance content skips over. They show you the chart, they tell you to invest more, and they send you home. But they don't address the real obstacle, which is never really about the money. It's about the architecture of your spending. Most households carry what behavioral economists call phantom expenses, recurring costs that are on autopay, never reviewed, and silently draining $300 to $500 a month without triggering any emotional response whatsoever. Subscription services never used. Insurance policies never renegotiated. Cell phone plans from 3 years ago that are now twice the price of a comparable option. Gym memberships. Streaming bundles. Delivery service markups. None of these feel large individually, Together, they are enormous. The average American household, according to research from Chase Bank, underestimates their monthly discretionary spending by nearly 40%. Not by a small margin, by almost half. That means the $300 gap between Daniel and Marcus isn't hidden somewhere exotic. It's hiding in the subscriptions tab of a credit card statement that most people haven't opened in 4 months. Now I want to zoom out for a second, because there's a version of this story that's even more powerful, and most people never reach it. What happens if Daniel doesn't stop at $500? What if, every time he gets a raise, he redirects half of it to his investment account instead of inflating his lifestyle? This is called a savings rate ratchet, and it's one of the quietest wealth-building strategies in existence. It's not dramatic. It doesn't require a side hustle or a second job. It just requires a rule. Half of every raise goes directly into the market before it ever touches your checking account. If Daniel increases his monthly contribution by just $50 every year, from $500 to $550 to $600 and so on, his retirement number doesn't go up by 10%. It doesn't even double. With that escalation strategy applied over the same 37-year period, Daniel arrives at something close to $4.2 million. Not because he became wealthy, but because he never let his lifestyle catch up to his income. That's the invisible wall that stops most wealth-building stories before they ever become interesting. Lifestyle inflation is silent, socially rewarded, and financially catastrophic over long time horizons. Here's the emotional truth underneath all of this, and I want you to really sit with it for a moment. Marcus and Daniel are not different people. They don't have different incomes, different talent levels, or different opportunities. The only difference between them is a decision made once, in a quiet moment, that nobody else witnessed and nobody else celebrated. There's no applause for choosing $500 over $200. Your friends don't notice. Your lifestyle doesn't change visibly. You don't feel richer. You just feel slightly more constrained in month 1, slightly less constrained by month 6, and completely transformed by decade 3. The wealth gap in America is real, but a significant portion of it isn't caused by differences in income. It's caused by differences in behavior that compound quietly over decades until the outcomes look miraculous on one end and tragic on the other. And here's the part that I think should change how you move through the rest of this week. The best time to make the $500 decision was 10 years ago. The second best time is before you close this video, because compounding is merciless in both directions. It punishes delay with the same mathematical force it uses to reward action. Every month you wait to move from $200 to $300, from $300 to $500, costs you not the face value of those dollars, but the multiplied future value of everything they would have become. Marcus isn't behind because he's irresponsible. He's behind because nobody ever showed him what was actually happening inside the gap. Once he understands it, everything changes. And that's exactly why you're here. The number you picked today isn't just a budget line. It's a statement about the life you're building, and it will echo forward for decades in ways that are almost impossible to overstate. So here's the question I want you to leave with, and I genuinely want you to think about this. What is the number you've been telling yourself is your realistic monthly investment? And when was the last time you actually challenged it? If this video shifted something in how you see that number, drop it in the comments. I read every single one of them. Tell me where you are right now. $100, $200, $500, more, and where you want to be. Because the conversation that happens in the comments of this channel is one of the most honest financial conversations on YouTube, and that's not an accident. That's what this community was built for. If you want to go deeper on how to actually find that extra $200 or $300 in your current budget without feeling like you're depriving yourself, subscribe to Noah Invests. That is exactly the kind of content we build here. Not motivation, not hype, but the specific, uncomfortable, and genuinely useful truth about how money actually works. And I'll see you in the next one.